Good afternoon. My name is David Jarvis, and I'm President, CEO, and founder of Corton Capital. Corton Capital is an asset management firm that specializes in traditional investments and alternative investments. Our goal is to create comprehensive portfolios for investors by marrying up both traditional and alternative investments for you. What follows next are a series of presentations and comments by various managers within the Corton family discussing the performance and successes that they've experienced with the funds that are carried within the Corton family. I hope you find it informative and we look forward to working with you. We are here to work with you and create comprehensive and interesting portfolios for you. Thank you very much.
All right, guys. Thanks for joining us. My name is Matthew Todman, and this is the February 2026 podcast on the Theta Alpha Fund. And we're going to talk, about the ongoings of the fund and what we're seeing into the future. So let's continue on here. Just one thing, talk about a disclaimer at the bottom. We'll leave that on for a few seconds, and we'll move on to the next slide. So this is me. I'm Matthew Todman. I'm the portfolio manager in the fund. I have about 25 years of financial services experience, about the same amount of options trading experience. I've had also a lot of real estate experience, and I'm also a chartered accountant. I went to U of T, finished my CA and CFA way back when, about 15, 20 years ago, and now I manage the Theta Alpha Fund, right? What's our macroeconomic environment looking like? This is actually the base layer for how we make decisions with respect to the fund. It is a top-down approach that we take on, along with actually a lot of in-depth company analysis. But we want to make sure that the sensitivity of the market is in a spot where we feel comfortable deploying, and we are constantly looking at what the environment looks like. And for that, we kind of look to our big four: our labor market, inflation, monetary policy, and interest rates, of course, right? So in the labor market has been, the source of some concern. We do see that kind of in a fairly static tug of war state. Unemployment has declined about 4.4%, down a little bit. Non-farm payrolls are chugging along reasonably nicely. The Fed noted, job gains have remained low. Unemployment rate has shown some signs of stabilization. So this is a question of this a wait and see environment. In terms of how we use this to make decisions, we are seeing the world through kind of, the very, very high level. Is the world becoming more or less uncertain? And, we'll certainly gauge other inputs into our strategy along the similar lines. But certainly, yes, we will definitely use kind of these big four macroeconomic factors and put them into, is the world becoming more uncertain or less uncertain? Inflation, despite what people say about, inflation's been defeated, I would argue that the numerical evidence hasn't really shown us that. Inflation remains the same at about 2.7% as of December. There's some stability, but it is still certainly above a Fed target of 2%, which they've mentioned several times. So we do want to see where that rate ends up going, and we have some charts to look at some historical data later on in the slide deck. But for now, this is also another wait and see. And we do have a terrible tug of war right now in the U.S. economy, where inflation and interest rates and tariffs are offsetting each other, and policymakers globally are struggling with what this looks like on a go forward and long term basis. Obviously, tariffs make things more expensive. That's another form of inflation. And if you pull interest rates down too fast, that's going to be more fuel for the fire and inflation as well. So you're looking at which balance and which equilibrium point will be needed to push the economy forward from that perspective. Monetary policy, that's the tool that the policymakers use to manage inflation, right? Benchmark rate now sits at about 3.75 to 4. The United States issues this in a range that's as of December. And, again, we're in a wait and see approach, guys, but we're expecting probably about 2 rate cuts this year. And, interesting note, one is typically expected before the Federal Reserve chairman changes, and perhaps at least one after. Recently, Kevin Warsh has been nominated by the president to be the next Federal Reserve chairman to succeed Jerome Powell. We do expect that, as he has been nominated by President Trump, who is advocating faster rate reductions, that maybe he will be inclined to advance the pace of interest rate declines. But at the same token, there is a segregation of duties between the Federal Reserve and the administration for a reason. So we have to see how this one plays out. But again, we're looking at likely 2 interest rate cuts this year. That's our opinion. But I'd definitely advise that you go see actual economists for this. We are in the money management business, and but that's what we are kind of factoring into our models. Moving on, yeah, this is what the historical data looks like. As you can see, the unemployment rate hasn't done much in the last couple of years. In fact, it's ticked up higher and higher still in the last few months. Non-farm payrolls generally in a downturn. We see this. We see this. It's not all that nice, because we want to see more jobs being created, but we don't see so many jobs that are being created that's going to cause inflation. So that's another type of tug of war that we are looking at. Now, how does this affect our trading of the portfolio? Well, quite frankly, if we see inflation coming around, we're going to take our foot a little bit off the gas and de-risk a bit. If we see inflation that's being kind of steady, monetary policy being in a reasonable appetite, again, that'll cause us to deploy more, have more of a risk on approach. The more uncertain, the less risk on. The more certain, the more risk on. That's generally speaking how we're going to manage this portfolio. And within that frame, there's technical opportunities that we are constantly looking out for to make those gains in yield as the year goes forward. Here's CPI. We did see it come down a lot in the post-COVID days of 2024. It is kind of ticking up, and as you can see, it's likely because of tariffs, right? That happened all in about April. Inflation got down to about 2.3% there, and now it's ticking up again, hit a high of 3. Was this unexpected? I don't think it was unexpected at all, right? So yeah, I think tariffs is something that I don't think we're entirely out of the woods yet, and I think it's going to take some special maneuvers with the Fed to really navigate this and lead into a result which is promising for the economy and the stock market. The problem. So that's our kind of macroeconomic view, and we use that to gauge sentiment of the market before we actually trade or manage the portfolio, right? We have to know what the sentiment of the market is. Now, with respect to the Theta Alpha Fund, why are we positioned the way we're positioned, right? Well, a couple of factors, right? As the title says, too many underwhelming funds. Nearly all funds underperform over time. Okay, well, we see here anything along the risk spectrum from Canadian equity to U.S. equity, international, global, et cetera, and percentage of funds underperforming after 10 years. Well, you can see it's pretty high, right? And in our opinion, that's due to a few reasons, right? One of those reasons that there's a lot of stocks which are often used in the average mutual fund, and the average portfolio could have upwards of 30, 40, 50, 60, maybe even 100 stocks, right? And it begs the question: Are you buying the portfolio with the hope of exceeding its benchmark, or are you buying with the portfolio with a reasonable expectation of you beating the benchmark? Right? There's no guarantee that you're beating the benchmark. And that being said, we have to mention a little bit about a benchmark. A benchmark is often the S&P 500, the Nasdaq 100, the the Russell 2K, maybe if you're into small caps. And often these benchmarks, they can be replicated by an ETF with very, very small fees, right? And you may be inclined to say, if I'm not beating the benchmark, may as well buy the S&P 500. It's very reasonable, right? So whatever portfolio you're in my opinion, it's probably a good idea to aim at beating the benchmark if you're going to be truly an active manager. And that's what we're trying to do here, right? There's obviously no guarantee, but we're trying to do that to actually produce alpha for the end client, right? And here you see like some of the top performing mutual funds. Okay, top performing mutual funds. One of the points I mentioned before is the holdings. Okay, and I'm a firm believer that we are only human, and we can only really think about a certain number of things, or stocks in this case, in our heads, and really keep track of only a certain amount of stocks. And when I see numbers like this, really Godspeed to anyone who can, truly understand 39 odd holdings or 34 odd holdings, which is on the low end, and upwards of 120 on the high end there. And it's an awful lot of a lot of work to truly understand 50, 60, 70 odd companies, right? And I think I'm a believer that less companies with more depth of knowledge in each company is better than a whole slew of companies with less breadth, which is just because we have a human factor limitation there, right? Because don't forget, you have to understand the companies and then position them in your portfolio that you're managing to truly try and get an alpha out of that portfolio, right? Let's keep moving on here. So, could your money be working harder for you, right? Well, you know what? Like if we look here, the S&P has done awfully well over the last, what is this, 1995, 31 years now, right? But the purchasing power of the dollar has actually gone down. So what's that really saying about your return? Well, truthfully, it's like, you have to consider an eroding dollar that's diminishing your returns, which you don't really feel right away, right? So again, another reason why buying the S&P 500 that can be very easily executed by simply buying SPY as an index, right? However, if you are trying to beat the index, something more is required here, right? So that's a good segue into like what we do in our fund, right? Our fund works on three main premises, right? Which are, in my opinion, empirically evidenced to a certain degree. There's a lot of empirical evidence that tells us that that a concentrated portfolio is kind of important. After a certain amount of time, there's a diminishing return for diversification. We're also going to look at options writing. There's a lot of empirical evidence to say writing options rather than buying them, you have a higher degree of probability that you'll actually earn a positive return, or they'll yield positive results. And lastly, seasonality. Not all months are created equal. There's a lot of historical studies that show that investing in certain months, you have a higher likelihood of success than in investing in others. And that's something we also take into account when managing the portfolio. So, concentrated portfolios, you can see here, like what is, do we have diminishing, do you have less, more and more diversification as the number of securities in the portfolio increases? And the answer is yes. The answer is absolutely yes. But for every additional security, your level of diversification doesn't go down linearly, right? And you can see at about that spot, about the 10, 12, 15 holdings, there's really not that much room for diversification benefits, right? And what's listed here is dividend versus non-dividend. A very similar graph is available for domestic versus international, growth versus value, U.S. versus U.S. versus emerging markets, et cetera, et cetera. The graph always looks kind of like that, right? And as the text says there, known as diversification, right? Yeah, it may not be. So when you're looking at a concentrated portfolio, I am much more comfortable understanding about 12 to 15 stocks really, really well, and to get that diversification, then the earning the benefits of it diversification and having very limited knowledge of potentially 60 or 70 stocks, right? Um, so again, you can't. This also impedes people beating the index, right? If you are buying the stocks in that are in the index and you look a lot like the index, you're making your job, that is to beat the index, all that much more difficult, right? You can't beat the index by looking exactly like it. You got to look a little bit different, or sometimes a lot different, right? So we focus on up to about 15 companies, and know them really well, and feel very strongly with a lot of conviction that they'll do better than the index. And that's kind of what our analysis is aimed to do. Winners take most. The Magnificent Seven stocks represent 32% of the S&P 500 and significantly outperform the index, right? The other 493 companies had a much lower return. And that's the way you beat the index. You isolate the winners and you weigh them in your to your advantage, and at a point where you believe that the potential return is worth the risk that you are taking on, right? And that's really important for us, right? And that's exactly what we did in 2025, and we continue to do that into 2026. Technology trends. Well, the Magnificent Seven, they are centered a lot around technology, right? And that's one of the biggest critiques of that type of portfolio, is that, hey, you have Magnificent Seven, they're all quite interrelated, they are dependent on each other. And the answer is yes, yes, largely yes, they are. But when you're looking for growth, literally, across North America, you land with the Magnificent Seven in some way, shape, or form, right? And the Magnificent Seven, they are focused on fairly popular technology trends, right? And you can see how fast these actually happen, right? For example, if you look at something interesting like the microwave in the 80s, look how fast that took off, right? Look how fast the smartphone took off. Bitcoin taking off pretty fast as well, right? And at the 100% mark, you're like, basically it's fully accepted, right? So we are trying to catch that wave, and we're doing a reasonably good job of it so far. Best performing asset class in 2011 to 2025. You can see here a whole bunch of asset classes going from, Bitcoin at the very top, right down to commodities at the very bottom, and no particular order there, but you can see here that typically NASDAQ has been an outperformer in that. Our benchmark is in fact the NASDAQ, and last in 2025 we beat the NASDAQ by about 4.8% after fees. So very proud of that year, and we're aiming to do the same. I think the unofficial numbers for January. This podcast is being recorded on the 3rd of February. We did beat our index by a little bit this last month in January as well, right? And you can see here, U.S. large caps, U.S. growth, NASDAQ, all in green as the best performing asset classes, right? And we continue to kind of use this data and pick stocks within these classes to attempt to outperform the index. So what's in the Theta Alpha Fund? Well, the first thing you can see here is, yeah, we do have a lot of the Magnificent Seven, absolutely. But we don't only have that, and it's not exactly the same. So when you look at our target exposure, which is quite a bit more than the target exposure in the NASDAQ 100. So we are taking a risk there to say, yes, we believe so strongly, we are convicted in these weightings that we're okay to hang our hat on them for now, right? What's not in the NASDAQ here? Okay, well, what's not in the NASDAQ is TSM, not in the NASDAQ, but we believe it's a good addition. What's also not in the NASDAQ? Well, Constellation, not in the NASDAQ, right? But we believe energy is a good play right now. What is also not on the NASDAQ? Well, Eli Lilly, right? But we are in that as well because we believe healthcare is a good play right now as well. So, this is an innovation fund. This is not necessarily and we have Bitcoin. We do have Bitcoin through the ETF. So if you take Bitcoin, you take TSM, you take constellation, you take Eli Lilly, and that is 8, 5, 4, and 3. So 13 and 7. So 20% of our portfolio is not actually um, NASDAQ or Magnificent Seven related, which is significant, right? But we believe that this is where the opportunities lie. So the fund details here, of course, we are allowed to take registered money, absolutely. Our fund code is there. We have about $18 million of assets under management right now. It is like, this is obviously, I'll say it explicitly, but it doesn't need to be said. This is a higher risk portfolio. Absolutely. It's meant for a growth investor. And, it's meant for a longer time horizon, right? And yeah, people that can buy this, you can be an accredited investor, a portfolio manager, or if you want to open an SMA account with us, we can include this in your portfolio. Okay. So yeah, we want, as I was mentioning here, we want exposure to innovation. We do our own research in-house, right? Our research analyst is focused on doing better for our fund, right? It's, the strategies are aligned, right? There's no other strategy, no other focus he has except doing research that aligns with the success of the fund. We again incorporate concentration, options, and seasonality. We have a very strong risk management framework that we've implemented throughout the portfolio management process. We also believe that this fund should be for everyone. Our minimum investment is $1,000, right? And we built this fund on educating the public on how to invest their money using options, using concentration, using seasonality. And this fund is a direct successor of that education, which we put out previously. If you wish to learn anything more about this, you can please contact myself, Matthew Todman. I'm the portfolio manager of the fund, or David Jarvis, who's the president of Quartron Capital and also portfolio manager at the firm. Please give us either a call, and we'd be happy to see how this fits into your portfolio. Thank you, and have a wonderful month.